All right. Welcome, everyone. Hi. Glad you could be here. It is another Financial Fridays with Sanies and Equitable. Today's topic is life insurance awareness. Now, Sanies is excited to offer these sessions in cooperation with our corporate partner, Equitable Advisors. And before we begin, we'll hear a few words from our sponsor.
Who Equitable Advisors is. We are a large financial firm. We've been a strategic partner of Sanies for the last 10 years. In that, we've had a commitment to the K-12 marketplace, making sure that educators are educated about their finances. We've been able to give those members additional support that's needed to make some of the biggest decisions in their life, like preparing for their retirement and their kids' college education. When an Equitable Advisor meets with a Sanies member, what our objective is to give them the confidence that they need going into retirement, making one of the biggest financial decisions they'll ever make in their life, to best assist them prepare with whatever their financial goals are. Equitable provides Sanies members includes financial resources and articles, complimentary financial profile meetings and an asset map, professional development educational webinars to units, and then in 2025 we're going to be doing a Ready to Retire series for people that are at least 1 to 3 years out from retirement and want to know how to finalize next steps. One of the benefits of being a Sanies member is on the first Friday of each month, we've always provided a Financial Friday series. It's a 30-minute series that goes from 12 to 12:30 that's presented by local regional representatives at Equitable that manage each region within Sanies on a variety of topics, including planning for the future, student loan forgiveness, and healthcare and retirement. What I would want Sanies members to know about the Equitable relationship is that you're going to have questions that come up, and there's always a tremendous amount of resources. There's an email address, saniesmembers@equitable.com, that can be utilized, and there's always somebody on the other end of that email address to address any questions, comments, or concerns. Best time to plan for retirement is today. Looking at the future immediately or as soon as you're able to, realistically, you're going to be best prepared for that future. Sometimes, if people haven't looked for the financial future yet, minimally 7 to 10 years out from retirement, that threshold absolutely must start because you still have time to make effective change, tweaks, and adjustments to your financial situation to best be prepared. The most important message for Sanies members to know is that Equitable Advisors is there to help them as life comes up. It is normal and it's going to happen where there's questions, concerns, things you're unsure about, and you've got a tremendous amount of resources to help and support you through that.
All right. Great. Now, so joining us today from Equitable is Nick Aguglia. Thanks for being here, Nick. And just a reminder to everyone, this session is being recorded and we will save questions until the end of the presentation. But feel free to add questions to the chat at any time. Our Q&A time is best used for general questions. The team is available at any time to answer your personal questions, and you can find contact information for your regional reps at sanies.org.
Perfect. Thank you, PH. I'm going to share my screen now. So can you just confirm that you can see it full screen?
Yes.
All right. Perfect. All right. Great. So again, thank you everyone for being on today. You can see the screen you said, right?
Yes.
Okay. Sorry. So again, thank you everybody for being on. Again, today's topic is going to be life insurance and risk management. I gave a brief introduction before we got kicked off, but again, just quickly, my name is Nick Aguglia. I'm one of the senior vice presidents for the Northeast region. I'm based out of Buffalo, New York, but as I mentioned, I do work and travel across New York State to assist other offices as well as individuals in various school districts across the area. So with that, we're going to go through and talk a little bit more about today's agenda. It's always tough to juggle evening schedules with maybe with kids, with soccer, with piano, with tutoring, with staying after school. For some people, maybe second jobs, let alone paying for it all. And then trying to find time to plan for our own retirement and our own goals. There was a study done probably about 5-6 years ago that showed that the average family spends more time planning their annual vacation than they do planning for their retirement or their financial goals. So our discussion today is going to aim to really arm you with information that you need to help get started, to stay on track, hopefully learn some things along the way. And again, if you have questions that are more general, feel free to fire them off in the chat and I will get to them towards the end. We're going to look at some advantages of preparing for financial programs, how to balance bills. We're going to talk a little bit more about retirement, clearly insurance, and the various ways that life insurance can be used, as well as having the funds to make sure that if something, God forbid, goes wrong, that we're not in a catastrophic situation, or our family members or loved ones left behind are not in a catastrophic situation. So the balancing act. So at the end of the day, everything we do with our finances, with our income, is a balancing act. So we know we're going to be dealing with money for the rest of our lives, but money, more or less, or just enough, is really just a tool that we use to help us look after our families and really enjoy our life. So how many people know right off the top of their head if they're on track for those major life's financial goals, whether it be helping to plan for a child's education, whether it be for retirement planning? How many feel that they could do maybe a little bit more to try and put themselves in a better position, or to just maybe spend the time learning of whether they're in the right position? So when you understand where you are and where you need to go, your financial life becomes so much easier. And I get it. A lot of people like to avoid finances, insurance-related matters like it's the plague. Right? And I always jokingly tell somebody that meeting with a financial advisor shouldn't be the equivalent of going to get a root canal. It should be more enjoyable. We should be able to ask questions. We should be able to learn things. We should be able to have engagement. And again, at the end of the day, remember that our financial goals are simply just our personal goals, but with a price tag attached to them. So you may find that there's a lot of choices. There's a lot of information. There's a lot of misinformation or counter information. So much so that sometimes it's really hard to plan out our expenses or plan out our income or our goals. So don't get bogged down too much with the details. I think that's the best advice I can give anybody, is take a step back for a second, talk to somebody who does this for a living, talk to somebody who has experience helping other families, other individuals in various situations, and just take the first step. So what the first thing is that you do when you buy a house, right? If we think about if anybody's bought a house recently, one of the first things that you do before you even buy furniture or decorations for the house typically is going to be purchasing home insurance. In fact, in most states, it's required by law. You have to have the homeowner's insurance, you have to have the homeowner's insurance prior to you actually close on the house. So what do you do if you have a family member who's dependent on you financially? Right? It's a difficult question to think about, but we really need to make sure that if, God forbid, us or our spouse died suddenly, what would happen? Right? Insurance, whether it be life insurance or sometimes health insurance or homeowners insurance, may not always be the most popular topic, but we need to talk about it because it's a vitally important topic. So everybody takes on a certain amount of insurance, whether you want to or not, whether you care to or not, everybody takes on some amount of insurance. And if we don't have certain insurances like health insurance or liability insurance or life insurance, well, we're still taking on that insurance, but we're doing something called self-insuring. And what self-insuring means is that in the event that one of those unthinkable events happened, you now have to bear the burden of those costs, or your family may have to bear the burden of those costs. So at the end of the day, insurance is just a way of transferring that risk to a third party. But like it or not, want it or not, everybody, consciously or unconsciously, is choosing an insurance program. And if we think about homeowners insurance or auto insurance, maybe liabilities, health insurances, So kind of your more basic forms, right? Helps to cover you for your everyday risks. A lot of people believe that, or understand that insurance coverage is really an economic necessity. However, there's a lot of areas of insurances that sometimes are misunderstood or overlooked. Those areas could be life insurance, it could be disability income insurance, it could be more and more commonly long-term care insurance, helping to protect us maybe from a nursing home, or the cost of a nursing home, I should say, or to help protect us so that our assets aren't, for lack of better words, robbed from us in the event we have some sort of long-term care event later on in life. And why are these types of insurances often overlooked? Well, I think perhaps the reason might be is because a lot of those coverages are voluntary, or the risk seems so remote. The chance of me passing away is slim, or I might not have to worry about any type of long-term care event for another 20, 30, 40 years. So we tend to put those risks out of sight, out of mind, because they seem unlikely or they seem so far in the future. However, those are the risks that can honestly threaten your family's financial independence the most, and making sure that we are adequately covered is so important. So I always like to ask the question, if you think about it for a second, what is your most valuable asset? And I ask this to a lot of different people. And most of the time, especially for state employees, they're talking about their most valuable asset being their pension, which again is a good answer, right? For most people, the pension is a very valuable asset. But really, the most valuable asset isn't a possession. The single most valuable asset that somebody has is going to be really themselves. What I mean by that is that it's the individual, it's ourselves, it's our ability to earn a living, to generate income, to create wealth, to create assets for ourselves, for our families. So the ability to generate that income, and that alone really allows us to obtain other wealth or other assets. And at the end of the day, it's the foundation of a family's security, both now and into the future. However, the ability to earn income is not always guaranteed. While it's difficult to think about or face mortality, or maybe the thought of a long-term disability, planning for it and making sure that we're adequately transferring the risk of it can really help to ease burdens, not only to ourselves, but to our family members later on in life. Now, if there are people who depend on you financially, then the need for life insurance is so important, right? It provides dependence with an immediate source of funds in the event that they were to pass away. The life insurance can do other cool tools. You don't hear cool and life insurance used together often, but I think life insurance is a very interesting topic because there's so much that it can do. It can also be used to help protect and maximize educators' New York State pensions. It can be used as an estate planning tool to help transfer assets to family members tax-free or in a very tax-efficient manner. So when you're purchasing life insurance, it's so important to consider a couple of things. We want to not just consider, the death benefit, although the death benefit is a very important part, and I get we also need to consider cost. We also need to take into consideration, what do we want the insurance to do for us? And a lot of that starts with understanding what life insurance can do. And I think the biggest misconception with life insurance is that I need life insurance when I'm younger, when I have a family, and when I no longer have a family and I'm older, the need for it diminishes. And that couldn't be further from the truth, especially for educators and state employees. Additionally, switching gears to more disability income insurance. Disability income insurance can help replace income. And it's a little bit unique with state employees. There are supplements kind of for further conversation in terms of what state employees are eligible for. But even if any of you, are thinking about a loved one or a spouse in the household, maybe that is generating an income, right? The importance of having some sort of game plan or contingency plan or insurance for a disability is extremely important. And according to the Council of Disability Awareness, just over 1 in 4 of today's 20-year-olds will become disabled before they retire. So 25% of people based off of, again, 20-year-olds today are going to have some sort of disability issue. So having that coverage, extremely important to ensure that we are protected and our families do not face an undue burden. So let's talk about different types of life insurance. So this is kind of where I think it gets fun, is learning a little bit more about different insurances that are out there. And I will say everybody, including YouTubers and TikTokers, all have, as well as financial advisors, all have opinions on different types of life insurance. And what I will say is every type of life insurance is good. They all serve specific purposes. So there is no such thing as a bad insurance policy or a bad type of insurance. But there are definitely times when one type of insurance fits somebody's needs better than another. So it's very important when working with somebody or when exploring insurance options that you are talking to somebody or that you are working with somebody who understands your overall financial goals, your overall financial picture, and your overall financial household. Which is why I always tell people life insurance should be purchased from a financial advisor who's also duly licensed to work with insurance and not an insurance sales rep. And it's not meant disrespectfully, but life insurance is not a commodity like an auto insurance or a homeowner's insurance would be, where you can just look for who's got the cheapest rate, right? And while cost and looking for cost efficient options are absolutely important with life insurance, again, understanding the type of insurance, what we want it to do for us, that is a lot more important at the end of the day. So without going too in the weeds, there's 5, I'll say, main types of life insurance that are out there. The first 2 probably what people are most common with if you have familiarity with insurance, and that first would be level term insurance. And level term insurance would be you take out an insurance policy for a set term, hence the name, or a specific period of time. And maybe that's 20 years. And we pay our monthly payment, and no matter what happens to our health during that 20-year period of time, we get healthier, we get less healthy, the insurance company is obligated, they are legally bound to provide us coverage during that whole term as long as we are making our premium payments. And in the event the unthinkable happens and we were to pass away prematurely, the death benefit would pay out to our beneficiaries 100% tax-free. Term insurance is relatively cost efficient, I'd say the least expensive of the options. And the reason why it's the least expensive is because most people, statistics around 98% of people, outlive that 20-year or whatever time period they take the policy out for. So it's a great way for somebody, you're in a situation where maybe somebody needs a temporary need, or somebody like myself who has 3 kids, and the expense over the next 20 years to get them through school, to get them through college, to get them maybe married, maybe help buy a first house, to help my wife continue on. The expenses and needs that we have today are maybe far greater than I would have in 20 years. So I'm okay with having something temporary, knowing that it serves a purpose. But like most people, I would still want to have coverage beyond that 20 years. So now we look to the other categories, which are more permanent insurance solutions. And permanent insurance is kind of a broader category. And within permanent, you have traditional whole life insurance. Most people are probably familiar, at least have heard of whole life insurance. And this is just a policy, again, being a permanent policy, if built properly, this type of policy should last you for the rest of your life. So where the term stops and ends and leaves off, the permanent can now maybe pick up, the whole life can pick up. So whole life insurance has a fixed death benefit. It also has a fixed premium. And as you put money into the policy, you actually start to grow or accumulate some cash in the policy, frequently referred to as the cash value. You earn a little bit of interest on this money like you would with money in a savings account at the bank. And in the future, if you ever needed to, you can possibly borrow from the policy, or you can take money out of your cash account. Whole life is relatively expensive and not as commonly used anymore, only because there are more modern, better, I'll argue, types of permanent insurance policies out there. And the next being universal life. And universal life works just like whole life, except it's a little bit more flexible. So it has flexible premium payments, flexible or fixed death benefit. You can choose. You can have it start higher, drop lower as you get older. But the flexible premiums are the really important one. And this is what allows you to be able to add more or less to the policy. It allows you to be able to, have some freedom and flexibility so that if we, are not working during summer months, or if we are, maybe out of work unexpectedly for a period of time, and we need a little bit of extra help with the bills, we can miss a few payments. We can possibly circle back, pay those back later. We also still have the ability to take a loan from it. So it's more of a modern version, a more flexible, and again, I'll argue less expensive and better version of whole life. Then we get down to the indexed universal life and variable universal life. And these are policies that are not only designed to last you permanently, like the traditional whole life and the universal life, they're also designed to help you accumulate and grow your cash faster. So think of it as an investment account. Think of it as your 403B meets your life insurance. So if, God forbid, we pass away, it still provides us a death benefit payout to our beneficiary. But in the meantime, our money is being invested into the market. And with indexed, it's being invested into indexes, if we're familiar, like the S&P 500 index. Usually, too, our account is 100% protected. So if we start the year at $10,000 and the stock market goes down 50% for whatever reason, at the end of the year, we still have our $10,000. Versus variable, we're investing in different mutual funds, or mutual fund-like investments, more like your 403B, so we can see the value fluctuate up and down quite a bit over the years. I go back to where I started. All types of life insurance have their pros and cons. They all have their, they all serve specific purposes, and learning and understanding what situations we may want to explore different insurance for is very, very important. So again, which of any is right? What I would encourage everybody, again, not to belabor my point, is I would speak with a financial advisor. If you have questions on insurance, somebody, again, who is duly licensed, somebody who hopefully understands your pension, understands the unique needs of state employees, and somebody who can help render advice based off of your whole family situation and your whole agenda and goals, and not just based off of a commodity, a insurance policy, again, like an auto or a homeowner's. So let's talk a little bit more about risk management, and then we'll wrap up in the next couple minutes here. So once you have goals that are set up, it's a lot easier to accomplish them. And that's why we always start with, again, a financial advisor will help create a plan. So let's start with these goals. Let's start with a plan. And then from there, right, we can figure out what the next best steps are. And it often seems that there are, many reasons to postpone the first step. Right? There's always, I'll look at this one, over the summertime, or, after school slows down, or after, after I hit a certain age, or, for some people, let's say I want to go to the gym and let me kind of get myself a little bit healthier first. And, and all of these things are they're excuses, or they're reasons to postpone, and they feel genuine. They feel like they're good reasons. But the sooner that you start a financial plan and investment program, that you start exploring risk management insurance options, the longer your money has to work for you, the more cost efficient the plan or the financial savings budget can be. So there's a lot of benefits of starting as soon as possible. So how does the process begin? So the investment process usually begins, using principle. So we look at somebody's overall financial situation. We say, okay, based off of your income, based off of your expenses, based off of when you want to retire, right? We take a look and say, how much monthly of a budget do we have in surplus? And in some cases, we actually have to help people find that surplus. And then from there, we can kind of go through and say, okay, now out of the income that's remaining, how much of this can we divert? How much of this can we utilize towards maybe putting in our 403b, or what I recommend to a lot of people, putting into a Roth IRA. How much of that should be used for our insurances, to protect our family, to protect our pension? Right? So it starts with a plan, and then from there, the answers become a lot easier. So to evaluate somebody's risk level, and this is going to go back to the overall financial plan, understanding how comfortable we are with risk is one of the most important parts of investing. And if this step is skipped, it can create undue anxieties later on in life. Right? When we first start saving money, our accounts are generally low, right? Because we're just starting something new out. We're starting it from scratch. And the more and more we save, the larger our account gets, but also the more fluctuations we can possibly see. And if we're not comfortable with that, it can cause us to make emotional decisions, maybe decisions based off of something we read or we saw, in some cases, political decisions. So making decisions based off of emotions or based off feelings is really a surefire way of making sure we never achieve those financial goals that we want to achieve. So understanding our risk comfort level, understanding how much risk we're willing to take on, going through some different scenarios will help us to better position to be able to deal with the low lows and also not to get too excited about the high highs. Because investing, saving, risk management is all about consistency. So risk management can refer to a lot of different things, right? We can talk about diversifying. Diversifying meaning not putting all of our eggs in one basket. We have money with the pension, right? We have money in our 403b. Maybe we have money in a Roth IRA to really capitalize on that tax-free benefit. We have some money is diverted to life insurance. Maybe we have some money in a local bank or a CD with a credit union, right? Having money in various different accounts in various different areas helps to not only grow our money, but it helps to protect us again by providing that risk management. It also helps with dollar cost averaging, which is a financial buzzword that I think is so important to understand, is when you are consistently putting money towards something, an investment specifically, every time the market goes down, yes, our account balance goes down along with it, but we have the ability to now purchase more of that investment at a much lower price. So the way I always equate this to, my wife would not be happy if I used her as an example, but regardless, when my wife gets that 30% off coupon in the mail for Kohl's, she never goes and saves 30%. She spends the same amount of money. She just buys 30% more stuff, right? Because her budget's the same. So maybe some people can relate to that. But the way that translates is that if an investment goes down by 30%, it's so nerve-wracking and emotional, and sometimes skewed or flawed logic based off of those emotions will tell us we should sell. This is not for us. This is crazy. We should just have our money in cash. But that's actually the best time to buy, because again, the market just gave us that 30% coupon. We're buying the same amount. We have the same budget. We're buying 30% more stuff. And now when the market turns around, which it always has over the last 130 years, we see much greater growth, much greater interest, much greater accumulation of our wealth over time. So having a plan set up where we're not just randomly trying to figure it out, but where we're systematically saving, right? All of you have access to a 403b. If you have friends, family members, spouses who work in the private sector, most of you are probably familiar with the ability that they have to save into a 401k. The reason why these programs work is because it's a systematic savings. And systematic savings, that dollar cost averaging, allows us to, again, to buy into the market without making emotional decisions. It allows us to buy weekly, bi-weekly, monthly, whenever we're contributing, and allows help to protect us against market declines and allows us to grow our money greater. So many things where to start, right? So right where we wrap up. So, the first thing to do is, again, it's to kind of get a little bit of a picture of your overall financial goals. Right? And it's to assess where do we currently stand. And I would say, honestly, the first step should be reach out to somebody, right? Don't go at it alone. right? Unless you love, kind of just doing all this stuff like we do, in which case, when you go to retire, let me or Kelly know. We'd love to have a conversation with maybe about you entering into the career. But if you don't love this or don't like stressing about this or paying attention to it, that's where, again, an advisor comes into play. So start by assessing the situation, start by reaching out to somebody who deals with this on a day in, day out basis. Find somebody that's going to educate you on the various solutions that are out there. Again, we're always available and accessible, as was mentioned in the beginning, to answer those questions for people. Clearly, if you know somebody or have somebody you currently work with, I pose some of those questions about insurances and risk management to them. And just do a quick health checkup and make sure you are positioned the way you want to be. With that being said, appreciate everybody's time. I'm going to check the chat here real quick, see if there's any questions.
Yeah, if anyone has any questions, feel free to use the Q&A or just directly into the webinar chat.
Just wait another minute. Feel free to take a picture of the screen if you want. My contact information's on there. You can reach out to me after over the weekend if you have any questions. Again, this is a topic I could talk on for 2 hours. Very passionate about it. Risk management, helping to protect assets. We spend so much time in life trying to just get by the day-to-day, to pay the bills, hopefully maybe spending some time focusing on saving money. We rarely take a step back, though, and think about how do we protect our money? How do we protect our income? How do we protect our families? And I think with September, again, being Life Insurance Awareness Month, is the appropriate time to take that step back, pause for a second, and just do a little financial health checkup. With that being said, thank you again for everybody's time. PH, I'll turn it back to you.
Yeah, no, thank you, Nick. Very helpful presentation. I think we got some messages in the chat there. So yeah, if anyone has any questions, feel free to contact Nick or your local regional Equitable rep. It's on our website under Equitable Resources. Doesn't look like there's any more questions, so we will end it there and have a great weekend and a great Friday, everyone.